Welcome to the 3-Edge Week in Review for the week of March 17th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. Today, Steve and I will discuss where the economy and the markets may be headed following the recent 10% correction in both the S&P 500 and the NASDAQ. And not only did the S&P and the NASDAQ both enter into official correction territory by being down over 10% from their February 19th highs, both indices have also fallen below their 200-day moving averages for the first time since the fall of 2023. And the 200-day moving average is simply a popular technical market indicator used to help identify longer-term price trends. So if there's a stock or an index is trading above its 200-day moving average, it's said to be in a technical uptrend. A stock or an index like the S&P that's trading below its 200-day moving average is said to be in a technical downtrend. So now the question on investors' minds is where are these markets likely headed from here? And there's such a high degree of uncertainty that the answer is certainly not obvious. Will investors buy the dip, focus on a reasonably healthy economy and labor markets and corporate profits? Or will markets be undone by the fears of a weakening economy, a resurgence of inflation, and of course the dramatic increase in uncertainty in large measure as a result of policies coming out of Washington, particularly around tariffs? I saw a recent quote that I liked a lot from Trevor Greetham, who's the head of multi-asset investing at Royal London Asset Management. And what he said was, it's not the economy that's hurting us here. It's the tariffs, the geopolitics, and the uncertainty itself doing the damage. And I thought that was a pretty accurate description. And speaking of central banks, Federal Reserve's FOMC met this past week, left interest rates unchanged. And in his press conference, Jay Powell went out of his way to reassure markets that the economy was in good shape, inflation was declining, maybe not as quickly as the Fed would like, but that the Fed has got this. However, at the end of the day, what the Fed and all of us are seeing is a slowing economy, and inflation still stuck above their 2% target. So let me bring Steve into the conversation here. So Steve, we had a 10% correction. We had a bit of a rebound, but it seemed to fizzle out, and just so much uncertainty hanging over the economy and the markets. And again, the biggest wild card is the Trump administration's policy. So, investors do want to know where we go from here, whether it will be Goldilocks or stagflation. So maybe we could begin by just having you describe, what would a Goldilocks environment look like from here, and what would a stagflationary environment look like?
Well, Goldilocks is the environment that's been propelling the market until recently to make new records. And simply, Goldilocks means that the economy is not too hot, not too cold, but just right. And what that means is that it's not too hot so that we have stable inflation, stable interest rates. It's not too cold so we have stable employment. And this is the perfect environment for both stocks and bonds. Stagflation, on the other hand, means that the economy is growing too slowly, and so unemployment starts to go up significantly. At the same time, inflation rises, so you have rising interest rates. And this is a terrible environment for both stocks and bonds.
All right. So clearly a big difference between these two scenarios, Goldilocks and stagflation. So let's dig in a little deeper, and maybe you could describe why getting this right is so important from an investment standpoint, basically why it matters.
Well, most of the time, the economy is in Goldilocks, and we've got stable inflation, stable employment, and this is a perfect environment for stocks and bonds. And Wall Street often says investors should have all their money in stocks and bonds. As high a percentage in stocks is consistent with the risk preference of that client, and fill the rest with bonds. And that works really well in a Goldilocks environment. But from time to time, we go into a stagflation. Now, it's quite rare. The last time we had a serious stagflation was in the 1970s. That was 50 years ago. But signs are rising that now we are trending toward stagflation yet once again. And as you mentioned, the Fed made an announcement, and while they're not saying that we're in stagflation by any means, they're still hoping we're in some form of Goldilocks. They did admit that threat of inflation is rising and that the threat of a slowdown is rising as well. And that puts us toward stagflation. So why it's so important is that while most investors still just have stocks and bonds, during a stagflation, the stagflation hurts both the stocks and the bonds. The slower growth hurts the stocks, the rising inflation interest rates hurt the bonds. There's no place to hide. And unless you have assets that thrive in the environment of a stagflation, you are going to have bad performance, and you're subjecting yourself to a lot more risk than you need to.
Excellent. All right. So now Goldilocks, stagflation, two very different potential paths for the economy and the market. And as usual, my third and final question is, what then should investors do, whether it's uncertain really which way we might go? How do you construct a portfolio or adjust a portfolio for this moment?
Well, I think it would be irresponsible to think we can't have a stagflation and to just be complacent and just stick with your stocks and bonds. And as I mentioned, there are certain assets that actually thrive and do very well in a stagflation. So our very strong recommendation is not to ignore the threat of stagflation, but to prepare against its possibility. And that means including those assets. So those assets that thrive in stagflation are TIPS, Treasury Inflation Protected Securities, gold, and short-term Treasury bills. Now, the reason why TIPS are designed to work actually in a stagflation is that the TIP offers today a 2% yield. In addition to that, you get the rate of inflation. And so if inflation rises, you're going to get more and more interest income on top of the 2%. And then finally, if interest rates are artificially held lower, as the new Secretary of the Treasury has indicated he wants to do, and inflation is rising, that means that the real or the inflation-adjusted interest rate is falling. And so in addition, with TIPS, you can get a capital appreciation as that real rate falls. So you can win three ways. You get the 2% plus inflation, which is now at around 3% and could grow higher, plus some capital appreciation if the real rate comes down. So TIPS are an excellent addition. In addition, gold thrives under stagflation. And under stagflation, you have a lot of uncertainty, and you have rising inflation, and often the Fed is either slow to recognize it, or there's an attempt to hold long-term interest rates lower, as I mentioned. And gold does very well when real rates fall, and real meaning inflation adjusted. And so we recommend owning some gold here. And then finally, short-term Treasury bills are much safer than longer-term bonds if we get an environment where interest rates start to rise again at all. And so, and they're earning just as much interest as longer-term bonds. So we believe that they also form dry powder. So if we do get the correction that a stagflation would produce, we would have the ability to buy back stocks at a much lower level than they are today. So these are all recommendations that we make. We're doing all of these things in the core strategies of the three-edge portfolios. And so just to summarize, because there is a threat of stagflation, because there is an opportunity that goes away, the Fed will have a hard time coming to the rescue if they're worried about inflation. Now, for 40 years, they didn't worry about inflation. We had the Fed put always supporting the market. Well, those days might be over like they were in the 1970s if inflation comes back. And so we highly recommend not to be complacent and just stick with your stock and bond portfolio, but to be hedged the way we're doing that for our clients.
Excellent. Thank you very much for that. And, our discussion reminded me of the phrase, may you live in interesting times, which is referred to as a Chinese curse. And of course, the phrase is intended to be ironic, since interesting times are often associated with trouble and turmoil, not good times. So wishing someone interesting times is not necessarily a good thing. But I am afraid that we may be living in interesting times throughout 2025. So thank you for your insight, all of that. One thing that I am sure of is that you and I will be here to explain all this to listeners, and we'll be working hard to keep our clients safe from whatever 2025 holds for the economy and the markets. So that will do it for Steve and me for this week. As a reminder, our videos are always available on our 3Edge YouTube channel. Feel free to share them if you think someone else might benefit from them. And if you enjoy the videos, please consider subscribing to our 3Edge YouTube channel. We'd appreciate that. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.